Welcome to Next Chapter Wealth, where we explore the issues and options you have now after that liquidity event. In this podcast, you will hear unbiased, objective insights from experienced professionals about the range of tools you have at your fingertips to manage your newfound wealth. Jonathan Hilton, thanks for coming on the show, man. We appreciate it.
Hey, no problem at all.
Well, tell us about who you are and what do you do? What's your background?
So my name is Jonathan Hilton. I've worked for the last 17 years for Andersen. Formerly, we were known as Wilton Tax Advisory Services. My background in terms of professional credentials is I have a law degree and a legal master's in taxation. And it was while I was taking tax classes in law school, I thought tax was really, really interesting. And I wanted to go kind of an accounting firm route rather than a law firm route. And I've been at the firm the entire time. It was serving ultra high net worth individuals.
I'm curious, just generally about the tax field, like what attracted you to it? You're like, tax is really interesting, right? For a lot of people, that is not what they're interested in. But I think for the right type of person, you can really gravitate towards it, right? What attracted you to the field?
A couple things. One, I've always really been interested in numbers anyways. Big numbers. And when you start dealing with individuals in the high net worth spectrum, when you're talking about millions and billions of dollars, that's just exciting to the mind, especially my mind. And then that, along with the character and issues that is in the tax world, just appeals to me. I think it's very highly detail oriented, very highly rule driven. And those two concepts, along with my love of numbers, it just kind of fits my personality.
So you said you were at Andersen, or you're at Andersen now. It's been through a couple different iterations.
Basically name changes is kind of what it was, right? Yeah. The background of the firm, and for those who just don't know, right, is it was initially started by former Arthur Andersen partners that were specialized in the private client service group of Arthur Andersen. After it imploded, they started their own firm called Wilton Tax Advisory Services. They got initial funding by HSBC because HSBC was really interested in getting a foothold in the United States. But they ended up buying HSBC out, starting their own company. They rebranded to WTAS. And then when we started expanding internationally, we ran into some domain issues in Europe with the name WTAS. And so it naturally needed a new name. And all of the groups that we were grouping up with and joining with internationally had a strong Andersen connection. And so we went through a lot of research in terms of what's the best name to go forward. And they chose Andersen. And to be honest with you, it's been one of the best decisions that the firm has ever had. Wow. It's just been amazing to see the growth that we've experienced domestically and internationally because of that name.
So that makes me think, right? So there's some very big tax houses, right? You got the big four, and then you got a lot of smaller ones. What are some of the biggest differences between these big tax houses, and how can people figure out which ones are best to work with? What questions should they ask themselves in order to figure out how do I even choose?
The thing is, during our discussion here, we're talking about individuals, right? Individuals that have tax questions and concerns that pertain, right, not to big companies, right? And one of the incredibly unique aspects of Andersen as a brand, especially domestically, is that still 50% of our revenue actually is generated by ultra high net worth individuals. Okay, that is completely different than any other big accounting firm that you'll see. Okay.
How is that defined, by the way? How is ultra high net worth defined?
From our perspective, typically we're talking about 30 million and above, but probably more 50 million and above. But it all just depends on the circumstance in terms of who is the right client for us. But I think where I'm trying to go is we have a national group as an example, right? Other firms have national groups too. But because of our focus on ultra high net worth individuals, our national group and resources are all geared for that high net worth individual. And they're geared to servicing them. And servicing individuals is not servicing corporations, right? Individuals have a much higher tendency to want to have quick answers. Deliverables that they don't sit there, they don't email some manager and that they've been working with that takes 2 or 3 weeks to try to figure out where in their organization is going to help them, and then try to come up with an answer after they spend a whole lot of time researching something, and then they try to deliver something to the individual. Because the big four is more orientated to the big companies. That's just what they're all about. And individuals, they need tailored service, right? Mm-hmm. And that's how our firm is completely organized for.
I see. So it's almost like
it's top down. Like the whole organization is geared for it.
Yeah. We were speaking about this the other day, and we were speaking with somebody, and they just landed a whale client, one of their first really big accounts, and we're thinking, if they haven't done that many times, it can really it'll throw off their concentration, right? They're gonna have a huge concentration on one client, but then also, what about the other little ones, right? And are they able to service the client in the way that client needs to be serviced, because they've been working with smaller clients in the past, right? So it sounds great, but it could be a big impact and not in a good way. Not to be a pessimist or anything.
Well, 100%. And the thing is, even in my organization, when you're not the right fit, then you're not going to necessarily be happy. The organization is not necessarily going to be geared and help you out the most, and you're not going to be happy with the organization too, in the sense of fees and what you end up getting. Because if your needs are just different and there's just a misalignment, then there's a misalignment. You're talking about trying to, if you get an A client or whatever, is the kind of thing, I think what you said. And if that's disproportionate to the rest of your clients, then you're not going to be able to properly service them because you're not geared for it. Well, the same is for me. If you come and you have a pretty simple situation and want our help, yeah, I could be able to help you, but you're not going to end up being happy, because the time that I'll spend on your return is way more than you want me to. And our fees will cost you way more than you think makes sense to. And to be honest with you, I'd say the same thing. I'm like, you're spending way too much money trying to utilize our services. And you can be much easier served by somebody who does not, it doesn't need so much attention to the detail.
Yeah. That makes a lot of sense. So tax policy, it's a fluid organism. It's like changing all the time, right?
Yeah.
First, I'm curious how it's changed over your career, but also some things stay the same, right? Like what's changed, but what's still the same as it always has been?
Well, I'll take this opportunity to talk about one of my favorite topics, which is something I deal with all the time, and that's QSBS, Qualified Small Business Stock. This is a super, super exciting topic. You ask how things have changed over my career. I've worked for 17 years, so I've been through a number of administrations, but at the same time, not as much as some of the other individuals that are more seasoned than me. But nevertheless, lots of things have changed. But QSBS is one of the interesting ones, because QSBS was started in the 1990s. And our firm was super deep into it relatively early on, because on the federal side, there wasn't much of a benefit for it, because it was a 50% gain exclusion, but the tax was still 28% for the remaining 50. But it was a California benefit. initially for a lot of our clients, especially in the early 2000s. And because for California, there's no difference between long-term um, and regular rates. And so if there was a 50% gain exclusion, our clients that were making millions of dollars potentially on transactions were going to be able to exclude 50% for California. Well, in any case, fast forward, well, during the Obama administration, they started changing, right, how QSBS really was being taxed. So it went from 50 to 75, then to 100% gain exclusion, right? So starting in the 2010, right? If stock was acquired then, and it was a qualified small business, 5 years after that, there could be 100% gain exclusion for stock sales up to $10 million or 10 times your basis. This has been huge, huge in terms of the benefit that it provides to taxpayers, and actually a lot of planning that goes into it over the last 10 years. All because of some of these policy changes. And the policy change really is trying to incentivize the high technology industry.
Interesting. So QSBS, that's one thing. Has anything else changed or like?
Oh yeah, there's lots of things that have changed. I wanted to focus on QSBS because
That's great. We can dig into
this
it.
is just something so important for clients, especially in the Bay Area. But across the United
So that's for specifically small businesses, correct?
right, well, early stage companies
Mm, mm.
that become bigger companies.
And that
So,
happens a lot in the Bay Area, I
well,
guess.
yeah. I mean, we're talking about all the big technology companies that have come up, sprouted up in the Bay Area in the last 15 years. Many of them have been able to benefit, or the founders have been able to benefit from qualified small business stock because they started off at zero,
Yeah.
virtually,
Is
right?
there
And they grew very, very quickly.
is there anything that okay, so there's probably a lot of parts to this QSBS. Is there anything that often goes overlooked that you need to keep reinforcing to clients and say like, oh, you gotta make sure you do this or make sure you don't do this?
You mean for QSBS specifically, or for
Yeah,
something
yeah.
else? Okay. Well, for QSBS, some of the big issues: one, making sure there's an 83B election filed, making sure you actually exercise your options early on, because the thing is, you may be given options at the start of the company or relatively early on in the company, but then you don't exercise them until they're worth a lot. Well, when you exercise them when they're worth a lot, this probably means it's no longer QSBS because you have to exercise them before the balance sheet of the company has $50 million in assets. So basically, that's one of the huge important things to remember. Now, one of the other things too that goes with planning is that there is the dual rule: 10 times your basis or $10 million gain exclusion. For early founders, there's lots of planning opportunities to try to multiply qualified small business stock gain exclusion, so it's more than just the $10 million. But that's there's a lot there. To answer your other question, I think for individuals that have operating companies that they're working with, that they're intimately involved in, one of the big changes, right, that occurred with the Tax Cut and Jobs Act is that no longer are state income taxes deductible. Okay, that was a very big thing for individuals, especially in California and New York. And New York led the way of developing what has now become the pass-through entity tax selection, where what could happen is if you're, as I said, if you're an operator, so if you're a partner or if you're owner of an S corporation, what you have the opportunity to do is still deduct state income taxes on your tax return through this thing called the pass-through entity tax selection. And it's still relatively novel. It's only existed over the last few years, but it has been a great benefit for clients that are on the right spectrum.
Interesting.
Jonathan, let me kind of shift the subject just a little bit,
Yeah.
and let's kind of put ourselves in the shoes of someone who for their career, or at least for the last 5 or 10 years, have been working as a W-2 employee of their company. And then they are purchased by private equity, by a strategic buyer. Maybe even they do an IPO, and suddenly there's a step change in their net worth. Up until this happens, they're bringing their information. They've hired a CPA. They've hired someone other than a CPA to do their taxes. But now they have meaningful net worth. How should they begin thinking about that tax relationship? Should they continue using that same person, or should they think about literally going through an interview process and finding somebody who's more attuned to those higher levels of net worth? Can you maybe give us color on that?
Right, and to be honest with you, I think this can be a somewhat of a difficult question. Again, it's going to be an issue of what the relationship is with their current provider, what that provider's other clients are, and how much of a change is going to be occurring because of this potential event. Now, if we're talking about, you're going from a W-2 of a few $100,000 a year to suddenly getting $25 million. It's like, if there's that kind of a change that we're talking about, what's going on is that person's tax return is going to become a lot more complicated, because they're going to have to invest all of those assets. Okay, and the allocation of how they invest it, if it's just in stock and bonds, or if it's going to be in private equity or venture capital or other types of investments, all of that's going to incredibly complicate the tax return. And if your provider is not accustomed to dealing with a big volume of information, of tax data, then it's something that the individual is going to really have to think about moving providers to just address that type of complexity.
And as they do essentially an interview process, are there questions that they should be asking in that interview process to find the right person?
Right, and that's an absolute great question. I think going back to the ideas like, who are your other clients? I think that's one of the most effective questions and discussions that I have with potential clients. They'll ask me, well, who else do you work with? And I could tell them who else I work with. That I work with, individuals that are multi-generational family wealth. I work with, former executives of Fortune 500 companies, and I work with founders of also of early stage startup companies that have made their wealth. It's like, those are the types of individuals that I work with. Is that you, or is that not you?
Right.
And I think that's just that kind of conversation with whoever you're going to be working with, I think, is very, very important. I think another important issue for clients is cost. It's like, how much are you going to be costing me, and is there a cheaper provider? Because speaking from the Andersons' perspective, one of our big things, and I was mentioning this earlier, is that we have a national group of people that are orientated to helping the ultra high net worth individual. My experience personally too, on the QSBS side, on serving venture capital principles, those types of issues, right, might not be applicable for everybody. They may not need international experts. For example, you're just this last week, since busy season kind of has ended, I'm dealing with issues with clients wanting to make a $20 million loan to a Korean company, and Korean withholding and the foreign tax credit related to that. I'm not going to know that information off the top of my head, but I need resources that do. Well, then the question is, for the taxpayer, is like, or for the client, is like, is this something, are you going to have really difficult international issues? Are you going to have complicated estate planning issues to address? And that's from a perspective of Anderson, these are the types of things that we can be really capable and helpful for providing to clients, and just may not be applicable to everybody. And so when you look at other types of resources, if you're interviewing with a tax preparer that just is your corner H&R Block concept, they're not going to have difficult probably difficult stock option or other equity compensation issues, you want to find a preparer that has good equity compensation background.
Exactly.
So I want to switch the topic a little bit. Talking about, instead of talking about a company, people that they're dealing with their companies, I want to talk about their actual families, right? So maybe somebody's in the audience and they have kids, or they're having a kid, or maybe they have kids and those kids are having kids, right? They're having a grandkid. Are there things they need to be thinking about from a tax perspective that to just make sure that they are protected?
There's lots of things that can go into this type of planning discussions, and it all depends on the client. I was just talking to one of my clients yesterday. He's worth $150 million, and he's made some good significant transfers to his kids and trusts, but he has lots of money left over that he could utilize for his lifetime exemption because he has $28 million to utilize between him and his wife. And he's like, I'm 47. And I'm not ready to give any more of my wealth to my kids. they already have. I already did a grat. I already gave them $20 million. I want to make sure I have all the money that I want to have during my life, kind of a thing. Whereas you talk to other people, and they're getting their $25 million liquidity event, and they're asking me, okay, how can I best utilize my lifetime exemption right now, because it might be dividing in half in next year, which is a big issue for people in the high net worth spectrum. And they're really interested in trying to do planning. So your question is like, okay, what should they be worrying about? Well, from a very basic sense, it's like if you want to be able to benefit your grandkids, you can benefit your grandkids by giving annual exclusion gifts directly in cash to UTMA accounts, or you can create trusts for their benefit and make annual exclusion gifts to them and not use any of your lifetime exemption, or utilize some of your lifetime exemption. You have up to $28 million between you and your spouse for the next year, and that might be cut in half starting in 2026. Another really great tool to help kids and grandkids is just loans that are really cheap. Mm-hmm. You can be able to extend notes to your kids and grandkids, not utilize your lifetime exemption, and maybe try to teach them some good finance and economics and budgeting by giving them a loan and making them pay it. Or forgiving the loan interest every single year, making sure that's underneath the annual exclusion amount.
Interesting.
So shifting a little bit, when, again, the step change in net worth happens, I have this bundle of cash, I need some presence in commercial real estate, or at least real estate in general. There are multiple different options. There is buying real estate. There is Delaware trusts. There is private REITs. Just on the surface, Jonathan, we don't need to go down the weeds, but it strikes me that there are tax-related questions in terms of making those decisions that you can maybe give our listeners some insight, at least in a general fashion, between those three choices and maybe others.
Oh wow! I mean, yeah, I think, Mike, that's a huge question. Trying to break that down a little bit too. It's like, if an individual, right, has already been investing in real estate previously and has been renting maybe their first home that they purchased, and they purchased a second home, and they're renting that one out, it's become a trader business. Great opportunity to do like kind of exchanges. Especially if they have a replacement property, if they want to sell it and then roll that over for tax deferred gain into another real estate project, that's definitely something that is still a huge benefit. Under the Tax Cut and Jobs Act, they kind of did away with a lot of the like kind exchange opportunities, but real estate is still left wide open in terms of tax deferral. And so that's, I think, a very, very important thing for clients to continue to consider. If they've never got into real estate and they want to have real estate exposure, what is the best way to do it? Well, if you're not a real estate person, maybe doing one of these real estate trust concepts might make a lot of sense. I mean, and there are other real estate projects that are out there that aren't necessarily REITs, that are just partnerships that invest in industrial sized buildings and allocate and leave it open for other partners to get involved in. And investment advisors would be the best person to source that type of work on. I don't get involved with the investment of the assets, though I can opine on tax issues. My one last comment too is everybody's different. I just met a client, a new client that had a big liquidity event, got $15 million and allocated 75% of that to buy 1,000 acres of raw land in an area that he thought was going to be developed. I mean, that was a 75% allocation of your proceeds to land. Seems a little aggressive on my end, or maybe ultimately conservative. I don't know. Maybe I don't know which one it is, but some people do that and they want to do that. I'm not going to opine on whether or not that's the right thing to do or not. But now the person's selling it for a whole lot of money. I think he bought the whole plot for 1,000 acres for $10 million, and now he's just selling 7 for $6 million. And so it's like he's gotten a lot of money from that investment.
And really where I was going was across that spectrum are the tax benefits, the depreciation, and other aspects, cost segregation, more or less even across the entire spectrum. Are there some that just from a tax perspective seem more beneficial than others?
Well, okay. So addressing because you brought up cost segregation. Cost segregation is going to be a potentially very important issue to go through if you've invested a significant amount in new property, right? So we're not talking about a 1031 exchange. What we're talking about is you've newly acquired a building, and that building is going to have a lot of components to it, typically speaking, and so you can accelerate depreciation on all of the light fixtures, or any of this wall paneling, or if there's built-ins or whatever. Someone can go through and say this asset shouldn't be depreciated over 39 years; it should be depreciated over 7 years. And that type of analysis, depending on the size of the project, can yield significant tax savings early, right? So the idea there being, though, that you've invested in this asset and you're planning on holding it for a long time.
Well, and it's clearly an aspect of the decision-making process, I'll bet you.
Right. I think it's very important. I mean, typically speaking, when you first buy real estate anyways, you usually don't have net income. It's usually for tax purposes losses because you can get the depreciation already. But if you're a rental real estate professional and are able to take the losses not as passive but as ordinary, and offset your other interest and other dividend portfolio income, because you're a real estate professional, that cost segregation study could prove immediate tax benefits.
Gotcha.
I don't know if that helped or not. It so depends on your perspective. If you do a 1031 exchange, though, cost segregation study probably may not help you, because what you've done with a 1031 is you buy a property 10 years ago, and you bought it for $1 million, right? Now you're selling it for $5 million, and you're gonna invest that into another $5 million project today. Well, your basis is going to be the same for depreciation purposes and just kind of continues on from the first project. So a cost segregation study in that instance probably doesn't make sense for the new property, even though it might be new, because your basis is still the old basis and your depreciation schedule is still the same.
What's fascinating about that comment is this is an exercise that I'm personally going through.
Okay.
and the cost segregation people, without asking any questions like what you just referenced in terms of the 1031 exchange, have all just kind of beat their chest and said, "Oh yeah, this will be great for you." So that's a very good nugget of information you just provided. So would it be so? Again, I'm an investor now. My company may have been bought by private equity, but
okay.
given the investment landscape these days, private equity might be one of the things that I want to engage in as an investor. It strikes me that there are also tax benefits around certain kinds of private equity also. Is that a fair statement?
Well, okay, it's going to depend on what investment that you make. So, for example, private equity may not have QSBS issues, typically speaking, because they're usually investing at later stages. Um, but if a private equity can invest in a qualified small business, then they might be able to pass that on to the investors. I'm trying to think of other potential benefits from private equity. You'd have to probably give me a particular circumstance, a specific example to kind of look at, like what their actual investment strategy is. To be honest with you, one of the biggest issues that happen with new clients that are newly investing in partnerships that they hadn't invested in before because they'd always been a W-2 employee was the issue of, oh, you're telling me I have to recognize $150,000 of income from this pass-through entity, but I didn't get anything from it. I don't understand. You're telling me I got $150,000 in tax from this private investment, but I don't see any cash. And I mean, it's kind of a basic issue of partnerships that individuals that are not in that world, that have just been a W-2 employee, have a hard time adjusting to. Which is like, if you make a private investment into an entity that is considered a partnership, right, a flow through, you have to recognize your share of profit and loss of that company, regardless of any income, cash that you receive during the year. And in some instances, right, you're giving them money because in the initial years, you're making capital contributions. And then they're assigning you income and not making distributions. You're like, I'm giving them money and they're telling me I have to pay taxes on that. kind of a thing. It's kind of a hard thing to adjust to. But I mean, I can't opine on the actual investment outcomes for these types of things because everybody is different. And I'm not an investment guy.
Well, so we've talked about investments. We've talked about giving to kids, to family members.
Yeah, right.
We haven't spent any time talking about charitable contributions, both because there's multiple structures for charitable contributions. You want
100%, yeah.
Give a little bit of a description of the different vehicles through which you see your clients make charitable contributions?
Yeah, okay, let's talk about charity, because charity is a very, very important concept for so many clients. One of the circumstances that we've discussed a few times during this conversation is somebody has a big liquidity event. Okay, they make the $25 million. Okay, in that year that they made $25 million, they have a lot more capacity from a deduction perspective to donate to charity and take a deduction. So if someone has some significant charitable intent in their life, they're going to want to make that charitable deduction in the year that they make that money. Because they may find themselves foreclosed on getting significant charitable benefits afterwards. Just as an example, if you're going to be making the $25 million, you have an objective to donate $5 million of that because you're a particularly generous individual. You recognize $25 million, you pay taxes on that, and then you wait to the next year, say, to make that $5 million charitable deduction. Well, then next year, your portfolio income and interest and dividends probably is only going to be yielding you, I don't know, $300,000, $400,000. If you're lucky, it's a little more than that. And you made a $5 million deduction, you're only going to get a deduction for $100,000 or $150,000, depending on how you do it. It's like, and that's all you're going to get. And then that can only carry forward 5 years. And then it totally is wasted. And so if you have charitable intent, one big thing to remember is you're going to want to make it in the year that you've made the money. Now, of course, it all depends. If your charitable intent is only a few $100,000, doing it over the course of your life after the charitable event is a fine thing to do too. And for California purposes, you might get a better benefit for it because California has the significant, deduction limitation that you have to clear the percentage.
So even as we're talking about, spend just a few minutes on structures like doing a donor advised fund, doing
Right.
a remainder trust, because those
Right. So
ways to into the circumstances maybe a little better.
Thanks, Mike, for bringing those things up. Those are definitely strategies that all my clients employ. Typically speaking, when they're looking at big liquidity events, sometimes people think about private foundations, and they try to think, okay, do I make my own foundation, or do I put money into a donor advised fund? Right, the donor advised fund, super easy. All the big banks have funds available for you. Basically, you just say, I'm putting this money, setting it aside for future charitable giving, because I don't know where I want to make that ultimately that charitable outlay. But let me put it into a fund, take the deduction, and then I can tell them later where the fund goes. The fund is you can't get the money back. That's why it's going to be a charitable deduction for you. But it gives you the option to do it later. Whereas a private foundation is the same concept. You've put the money, you've set it aside for charitable donations, but the difference being you're responsible for annual tax returns and other compliance issues relating to that entity. And there could be some significant California compliance ramifications as well if you're a California individual. And because of that, donor advised funds are typically much more preferred for individuals unless they're in the $100 million plus range. And the objective for the donor advised fund the objective of the private foundation is a legacy issue rather than a donation issue. And then the CRT option. CRTs are great. CRTs, to be honest with you, are much less a charitable vehicle more than it is just an income tax saving tool, right? Because basically what you're doing with the CRT is you're taking stock that you have in a company that you're going to be able to sell. Typically speaking, we're talking about companies that have gone public, so they're going to be a publicly traded stock, right? And instead of recognizing tax on the sale of stock, you put it into a CRT. The CRT sells it it doesn't have to pay any tax, and then the CRT can allow the proceeds of that to grow tax-free, and it will make income distributions to you over a course of years that you've already predetermined. You do have to pay tax on the income that you get from the CRT, and then after the term that you've prescribed, it goes to charity. Well, the way that the economics work with it is you actually will be often better off economically having made the CRT decision. So you don't have to even really be charitably inclined to have it benefit you to do the CRT.
Understood.
I really went over the CRT very quickly, and I hopefully people kind of can understand that. I don't know if you have
CRT
questions to help
stands for
a little bit more.
It stands for Charitable Remainder Trust, right?
That's right. It's a charitable remainder trust. Right.
What's remainder? Why is it called that, by the way?
Great question, Ryan. So it's called a remainder because the way you've structured it is that after you've gotten income from the trust over a prescribed period of years, there's going to be a designated remainder that's left over in the trust that you didn't distribute back to yourself that is designated for charity. Okay, so for example, you put $10 million into a CRT. That's a 10-year CRT, and you're getting 5% every single year back from the CRT, right? And what happens is you do this calculation, and you say, well, given those parameters that you're going to get 5% per year for 10 years on this $10 million principal, at the end of the 10 years, the donation that's going to be made to the charity, the remainder, is going to be $3 million. And then what you say is the present value of that $3 million, say, is $1.5 million. So you get a charitable deduction for $1.5 million in the year that you create the CRT, which is a great tax benefit, right? And then the $10 million grows tax free, and you get 5% of whatever that principal is over the course of the 10 years. But you do have to recognize tax on the 5% that you get out of the CRT every year. In any case, you run through the economics with this, and because of the non-taxable aspect of the initial $10 million sale of stock, because there's no tax on that and it can grow tax-free, you end up being economically better off. And you have to do the calculation to confirm all this, but...
Yeah, there's software. So Ryan, I've monopolized much of this. I'm going to let you ask your questions, and then I'll let you kind of take it to the end.
Sure. Well, I think probably the final question we have is that, so the audience might be filled with people that are in their upper 50s and 60s. What should they be thinking about when it comes to managing their tax burden over the next 10 years?
Well, of course, it's going to depend on everyone's situation, right? If we try to think about some of the general concepts that occur, right, is as you start getting older, right, potentially the amount of work that you're doing is going to stop, right, or is going to slow down, right? And at some point, you have to start taking retirement distributions from IRAs or 401ks if you need to do that. So going back to what we were talking about, charitable deductions are important in bigger years. So you want to start thinking about making sure you make any charitable deductions that you want to make maybe now rather than later when you don't have as much income. There are ways in which, for estate planning purposes, if you found yourself with a lot of accumulated wealth, you want to start benefiting your kids and grandkids, and we've already talked about the creation of trusts for your grandkids or for your kids, and doing interfamily loans with the extra money. From a retirement account perspective, I think it's the time period where you do a portfolio reallocation. Generally speaking, 401ks and retirement accounts are geared for long-term growth, and so people typically are very aggressive with the equity choices that they make within retirement accounts when they're in their 30s and 40s, and then maybe even starting in their 50s still. But then at some point in time, you want, for those retirement accounts, have to shift to more conservative investing. So you have a retention of principal. And so that's something that I start thinking about as you're edging towards retirement age, to make sure your retirement accounts are not as aggressive as they were previously, because they're not going to have as long of a period of time to continue to grow and to deal with the ups and the downs in the market.
Yeah.
So there probably are a number of other things that I just haven't said, but I don't know if that was helpful.
Fair enough. I have one final kind of selfish question, and then I think we can wrap it up. My selfish question is that, so I have pensions in the UK, right? I lived in the UK for 4 years, and
Nice.
I don't know how to get them out. Any idea? How to
I
get 'em out?
hope you are filing a foreign bank account report for those.
Yeah.
Okay, so you are good. I'm glad you
FBAR,
filed.
right?
What was that? The FBAR.
The F bar? Yeah.
Yeah, you're filing the FBAR for those. And then your question is how you get the money out of the UK and transfer them into the United States.
Yeah.
I'm going to have to connect you to one of my UK colleagues, who
That's fine.
I just had lunch with a few of them that were visiting from the UK this last week in San Francisco. Great individuals, and their specialty. And this is one of the great things about working for an international firm. There's in the UK and in Canada both. The practitioners actually do both U.S. and taxes in those countries. So they do Canadian taxes and U.S. taxes. In the UK, they do UK and U.S. taxes. Whereas us domestic U.S. people, we're just U.S. people. There's very few U.S. practitioners that are going to be doing multi-jurisdictional things in terms of filing in foreign countries. But yeah, so sorry, I don't know the exact answer to how do you get your money back from the UK, but I'm pretty sure
That's
there are going to be UK issues that you're going to have to deal with that.
I bet.
And also US issues that you're going to have to be dealing with that in
Can't
terms of
wait.
recognition of income. But let me know. I'll connect you with them after the call.
That's wonderful. Well, just one final question, just personally, like, We have some like things we like to ask the guests. First thing is, what are the tools you like using in your kind of day-to-day work? Like any apps that you really like that you recommend to people?
Apps? No. I
Yeah,
don't
like
think
like
so.
general apps that you like using.
I do like listening to, they have some nice tax like podcasts that I like to
Oh,
use to try to, get caught up on
which
some.
ones?
And, Bloomberg has some really great stuff too
They
in terms
do.
of.
You like Odd Lots? You ever heard of Odd Lots?
No, I haven't heard of them.
Oh, it's not like tech specific, but they do cover a lot of various topics, and it's they get great guests. They get great guests.
Really cool. Well, yeah, if you can send the information to me after.
Definitely send that to you. Well, how can people find you if they want to learn more about what you're doing?
www.anderson.com.
Are you on LinkedIn as well?
Yeah, I'm on LinkedIn.
Okay, we can direct them to your LinkedIn as well. Well, Jonathan Hilton, this has been an education and a pleasure, so we appreciate you coming on.
Hey, no problem at all. It's been a pleasure.